on to part 2 of this combination learning objective 4 and 5. And what we're going to be looking at here are just the theoretical structure of the statements and how they're interrelated. So I'm not using examples in this part. I'm just focusing on what should be on these statements, what's contained on these statements, and then in part 3 we're going to look at Amazon's actual statements. We're going to first start talking about the income statement. The income statement reports revenues and expenses, and this is the only statement that those items are on. It will calculate a net income or a net loss. The general form for the statement is revenues minus expenses, and if revenues exceed expenses, the company has net income. If expenses are larger than revenues, then it has net loss. And when we have a loss, typically you will see parentheses around, and that means a loss. And the income statement is also called the statement of operations. The next statement that would be prepared would be the statement of retained earnings. This opens with the beginning retained earnings balance. It adds net income or subtracts net loss. And this net income or net loss comes directly from the income statement. That's why the income statement needs to be prepared first. And it ends up with the ending retained earnings balance. And this is the portion of net income that the company has kept. Now, Amazon doesn't have a statement of retained earnings. They have a statement of stockholders' equity, which is a more comprehensive statement. The statement of stockholders' equity includes the statement of retained earnings. Now we come to the balance sheet. The balance sheet is where it reports the detail of the accounting equation. If you think about the accounting equation, it's assets equal liabilities plus equity. Well, on the balance sheet, we have assets, we have liabilities, and we have stockholders' equity. Those accounts are contained on the balance sheet. The balance sheet will show us that our assets equal the sum of the liabilities plus stockholders' equity. So that accounting equation that we already looked at, assets equal to liabilities plus equity, that is the format for the balance sheet. The balance sheet report shows retained earnings, which came from our statement of retained earnings, which we calculated right before this one. And the balance sheet is also called the statement of financial position. Typically, the balance sheet is a more common term, but it is also statement of financial position. Now, when we talk about assets on the balance sheet, they're typically shown in two groups. The first one shown, are current. These are expected to be converted to cash, sold, or consumed in the next 12 months or operating cycle. They include cash, short-term investments, accounts receivable, notes receivable, inventory, prepaid expenses, and we'll get a lot more into depth at these as we go. Now, we also have the long-term assets on the balance sheet, and these will be held longer than a year. This is going to include things like land, buildings, computer, equipment. All of those combined are called something property, plant, and equipment. And we also have intangibles, which are things like copyrights and patent, and then long-term investments. So assets on the balance sheet start with our current assets, which are things less than a year till maturity or converted to cash. And then we have the long-term assets, which come after the current assets, and there are things that are going to be held for more than a year. We also have liabilities on the balance sheet, and liabilities are also presented in two groups. First of all, current liabilities are presented first, and these are debts that are payable generally within the next year. It includes accounts payable, income tax payable, accrued expenses, and in future chapters we'll talk much more about that. And then we also have our long-term liabilities. Long-term liabilities, more than 1 year. They're due more than a year from the balance sheet date. This would be our long-term notes payable, like a 30-year mortgage, bonds payable, things that are out more than a year into the future. We also have stockholders' equity on the balance sheet, and this is the stockholders' ownership of the business assets. Going to include roughly three main groups: common stock, additional paid-in capital, and retained earnings. And again, later in our later chapters, we'll go into much more detail. And the fourth statement is the statement of cash flows. And this is going to tell us where our cash went and where it came from in three main groups. Operating, which is our reason for being. What are we in business for? Here's what we sell, here's our service, and these are the cash, here's the cash provided by and used by those activities. And then investing. Investing is where we put our money and what we do with it. And then financing is the debt portion. So the statement of cash flows is going to show us the sources and uses of cash broken down by those three, and it's going to end up reporting our ending cash balance. Let's talk a little bit more about that relationship between the financial statements. The income statement is the first statement that we prepare, and what we end up with doing, these are very condensed. We end up with the net income on the income statement. That flows down into the statement of retained earnings, which is the second statement we prepare. Notice that this statement of retained earnings ends with ending retained earnings. Now that ending retained earnings that we just pointed out, it moved to the top of the screen so we could show this is the second statement. Our third statement is the balance sheet. And the balance sheet, the ending retained earnings, goes in the equity section there. And then the balance sheet, the cash balance that would be up in the asset line, feeds down to the cash balance on the statement of cash flows. The statement of cash flows is the fourth statement that we prepare. On page 24 in your text is a nice table talking about how we can evaluate a company by looking at its financial statements. And these are real basic questions, and we're going to look at them in more depth as time goes on. But basically, you can look at, can the company sell its products or services? What are the main income measures to watch for? What percentage of sales revenue ends up as profit? And those are the kind of questions that we can answer with the financial statements. Just a reminder, bring Appendix A and Appendix B to class each day. Appendix A is Amazon's annual report. Appendix B is Radio Shack, and we're going to be using those in a variety of ways during class. Okay, so that brings us to the end of Part 2, which is kind of a high-level overview of what goes in those statements and how they're interrelated. Now we're going to go to Part 3, and Part 3 we actually look at Amazon's financial statements.